China has become the world's largest auto exporter.
$9,200 equivalent US dollars.
Chinese automakers are going to come here eventually, and they're going to do it regardless of if there's a tariff or not.
Chinese brands control about 2/3 of the Russian automobile market now. They dominate the industry.
China's automotive industry is set to maintain its leadership in global markets in 2025, with a major industry think tank forecasting total vehicle sales to reach approximately 32 million units in 2025, representing a 3% year-on-year increase. Zhang Yongwei, Vice President and Secretary General of the China EV 100, gave the estimate last week. He expects new energy vehicle sales in the year to hit 16.5 million units, achieving a growth rate of roughly 30% from 2024. He went on to explain that the domestic NEV market will comprise 15 million units, supplemented by exports exceeding 1 million units. Well, here are the details of top 10 predictions in Chinese car market. Number 1. Rising bankruptcy rates. Around 1/3 of all new startup companies in the electric vehicle (EV) industry are expected to go bankrupt in the coming years, primarily due to the fierce price wars and the continued dominance of BYD in the new energy vehicle (NEV) market. In China, the term NEV encompasses both all-electric vehicles and plug-in hybrid electric vehicles (PHEVs). The intense competition, combined with the rising costs of production and the overwhelming market presence of established giants like BYD, is proving too much for many smaller companies to survive. Neta, once touted as one of the largest emerging brands in the industry, is set to collapse by the first half of 2025. This will add to the growing list of casualties in the NEV sector, following the 2024 failures of companies such as GU and Hi-Fi. These high-profile bankruptcies serve as a cautionary tale for other aspiring EV manufacturers, highlighting the challenges of competing in a market increasingly dominated by a few powerful players. As the industry consolidates, only those with the deepest pockets and the most robust business strategies are likely to thrive in the face of such fierce competition and pricing pressures. Number 2, growing penetration of electrified vehicles. The NEV penetration rate in 2025 is expected to range between 55% and 60%. While sales are anticipated to experience a dip during the first few months of the year, primarily due to the Chinese New Year holiday on January 29th, a recovery is expected to begin in the second quarter. Sales should accelerate throughout the second half of the year, driven by increasing consumer demand and improved market conditions. Although there may be occasional months where the penetration rate temporarily falls below 50%, the overall trend will be upward, with the rate steadily increasing as sales gain momentum in the latter half of the year. This gradual rise in the NEV penetration rate reflects the growing acceptance of electric vehicles in China, as well as continued advancements in technology and infrastructure that make EVs more attractive to consumers. The second half of 2025 is likely to see a significant boost in NEV sales as automakers ramp up production and more buyers transition to electric mobility, further solidifying the sector's dominance in the automotive market. Number 3, SAIC seeks to acquire. Its way out of trouble as SAIC's increasingly desperate situation is likely to force the company into making strategic acquisitions in a bid to maintain its relevance in the competitive automotive landscape. This has been driven by a significant decline in sales through its joint venture with General Motors, struggling sales within its Volkswagen partnership, and a drop in demand for its own brands. Currently, ChinaCarMarket is heavily reliant on the Wuling joint venture for sales, especially in the new energy vehicle sector. However, the majority of Wuling's offerings are budget-friendly, which translates to limited profit margins. As a result, ChinaCarMarket is likely to seek a more profitable acquisition to boost both its sales and its financial position. One potential candidate for acquisition could be Xpeng, a rapidly growing player in the EV market, in which Volkswagen already holds a stake. By acquiring Xpeng, ChinaCarMarket could tap into a more successful, higher-margin segment of the market, potentially revitalizing its position in the industry. With the automotive market rapidly shifting toward electric and new energy vehicles, ChinaCarMarket's best chance at recovery and growth could lie in embracing a new, innovative brand to complement its existing portfolio. Number 4. Mergers among state-owned enterprises, SOEs. A merger, potentially a forced one, is expected to take place between several underperforming state-owned enterprises, SOEs, in China's automotive sector. FAW, Dongfeng, BAC, and GAC are all likely candidates for consolidation due to their ongoing struggles with sales and profitability. Among these, a merger between FAW and BAC seems the most plausible. Both companies have been experiencing declining sales from their joint ventures, while also struggling to make significant progress in the new energy vehicle, NEV market. By combining resources, expertise, and production capabilities, a FAW-BAC merger could help create a stronger entity capable of better competing in the increasingly competitive and electrified automotive landscape. Such a move would allow them to pool their financial resources and invest more effectively in NEV development, which is critical to their future survival. This consolidation would also help streamline operations, reduce costs, and ensure the continued relevance of both companies in the evolving market. Number 5, increased closures of joint ventures. At least 3 joint ventures, JVs, are expected to cease operations in 2025, with the most likely candidates being Hyundai, Jaguar Land Rover, Ford, and General Motors. Many of these JVs have been struggling in recent years, with their NEV sales penetration significantly lagging behind that of most Chinese brands. As the Chinese market increasingly shifts away from internal combustion engine, ICE, vehicles toward new energy vehicles, NEVs, these foreign joint ventures face an increasingly difficult situation. Their limited adaptation to the transition and inability to compete with local manufacturers will make it harder for them to maintain a foothold in China's rapidly evolving automotive landscape. Number 6, joint ventures adopt Chinese EV technology. In response to the challenges facing joint ventures in the Chinese market, at least one JV brand is expected to adopt cutting-edge technology in a bid to develop a credible new energy vehicle, NEV, offering. Among the most likely strategies is the adoption of the CATL Bedrock skateboard chassis or the Huawei Harmony OS combined with the Qiangkun ADAS system. By integrating these advanced systems, the JV brand can create a competitive NEV that meets the demands of the Chinese market. If the CATL Bedrock system is selected, it may also have the potential to be exported to other regions, leveraging the growing global demand for electric vehicles. This move could help the JV brand regain relevance in a market increasingly dominated by local manufacturers, giving it the technological edge needed to compete in both domestic and international markets. Number 7. Lexus follows Tesla's lead in China. Lexus is set to announce plans for a new factory in Shanghai, a move that follows earlier rumors in July 2024, which were initially denied, and further speculations in December, also dismissed. Despite the denials, the company is now moving forward with the construction of a wholly owned facility similar to Tesla's model in China. This new factory will focus on producing vehicles primarily for the Chinese market, but at least half of its production is expected to be earmarked for export. Lexus aims to strengthen its presence in the global EV market by tapping into China's advanced manufacturing capabilities and growing demand for electric vehicles. Number 8. Surge in sales. Car sales in China are expected to reach 30 million in 2025, solidifying China's position as the world's largest car exporter, with a projected 6.5 million units sold overseas. BYD will remain the dominant player in the market, continuing its reign as the largest car company in China with 6 million units sold. Xpeng is also set to see impressive growth, selling over 400,000 vehicles. However, NIO will once again fall short of its targets, despite improvements in profitability, particularly with the introduction of the NIO ET9. Li Auto is forecasted to sell around 600,000 vehicles, though its all-electric models are still struggling to meet expectations. Xiaomi, on the other hand, will see remarkable growth, more than doubling its sales in 2025, likely surpassing 350,000 units for the year, driven by the successful launch of the YU7. Xiaomi's strong performance could see it outsell NIO, marking a significant milestone for the tech giant in the automotive sector. Number 9. Model featuring solid-state battery. Toward the end of 2025, a Chinese automaker is expected to announce plans for a new model set to debut in 2026, featuring an all-solid-state battery. The most likely candidates for this announcement are MG, GAC, or Chery, all of whom are actively developing solid-state batteries and have stated intentions to mass-produce them by 2026. These companies are making significant strides in battery technology, positioning themselves at the forefront of the EV revolution. An unveiling at the 2025 Guangzhou Auto Show is highly anticipated, with the potential for a concept model to be shown earlier, possibly at the Shanghai Auto Show in April. The introduction of solid-state batteries could be a game-changer for the Chinese EV market, offering improved energy density, faster charging times, and enhanced safety compared to traditional lithium-ion batteries. This innovation could help these brands gain a competitive edge both domestically and internationally as they continue to push the boundaries of electric vehicle technology. Number 10. The arrival of autonomous driving. By the end of 2025, several Chinese automakers will likely claim to have achieved full parking-to-parking smart driving with no interventions, leveraging advanced ADAS systems. These systems will utilize end-to-end AI models capable of handling all aspects of driving, from parking to navigation, without the need for human intervention. Huawei or Xpeng are expected to be the first to announce this capability, with other companies following suit as the technology matures. This significant advancement will further push the boundaries of autonomous driving in the Chinese market. Thanks for watching. For more informative and market-oriented videos, like and subscribe to our channel.